There we go. So first off, thanks everybody for coming. Again, these are just a couple more things that I wanted to go over with you guys just to get some ideas of what's out there, that kind of thing. Um, I'm going to take the first little part, and Rich is going to take the second one, just to kind of go over some things that you might be thinking of with your clients when you as you all know this market. I mean, how many memes and videos have you seen about, like the one with the apple, like, okay, I got an apple for sale, $5. It's like, wait a minute. It's like, the people haven't even had a chance to take a look and see what these houses are. They're putting huge bids in, and it, the market is just ridiculous. So these are a couple items to try to, uh, I guess we'll say, put the numbers in your guys' favor a little bit more. Um, and when you get into a situation with trying to help your buyers find a place, maybe these might be something that you work with. The first thing, which I'm going to go over, we've been doing them for a little while. It's something that's been around for a long time. So I hate to admit to it, I actually did this with my when I bought my first place in Lake in the Hills. I had a situation where I was selling a condo in Mount Prospect. And what happened was 2 days before the guy bought my condo, you can guess what he did. He bought a car. So guess who no longer qualified to buy my condo? So here I am 2 days before closing, and I'm supposed to close on my house. And I'm like, I don't know what to do. I'm like, do we let all this just fall through? So his attorney gets back to us and says he thinks he has the ability to get a co-signer. We just have to close later because obviously it's going to take time to be able to figure out what to do. So my loan officer said, "Hey, what you could do is if you can come up with a gift of 5%, we could close now, and then once you close on on the condo, you'd be able to take that money and put it down on the property, and they basically, it's almost like a refinance without having to have all the parts of the refinance." So what happens is, so I closed on the town, or I closed on my house. I was able to borrow or gift the 5%, to be able to do, for the purchase. And then when my condo sold, I took the rest of the money and I sent it into, I believe it was actually PNC or National City back then. And we're talking like 15, 20 years ago this happened. And they restructured the loan. So I got one payment that was like, let's say it was like $2,000 a month. And then the next payment, when it recasted, my new payment was like $1,300 a month, back where I expected it to be. So what happens is I had to qualify for both mortgages. Okay. So I had to be able to qualify for my condo and the new purchase. And as long as I had the money for the down payment and I qualified for those two payments together, I could do this. Okay. Um, so um, what you see a lot is, people that need to sell a house to be able to, they want to sell the house to be able to buy another house. They're buying up, especially with rates where they are. And then you walk into a place, I was talking to another agent. She said she had like 100 people at an open house. How are you going to separate yourself from all these 100 people? So what happens is, instead of having to write um, a contract with a with a sale contingency, even though they have another house, there's no more sale contingency. So as long as they qualify for both,
Yeah.
they don't have to say on, I don't have to say on the pre-approval letter, they must sell the property at 123 Main Street to be able to qualify. Instead, it's, I've checked the assets, I've checked the debts, they qualify, so now you can close. And the other thing it also does, which I've also seen a couple other times, is it gives people time to make that move too. So instead of having to do it all in one day, and let's say they're, and as we all know, how many days does the the sale of a house actually close on the correct day? So let's say it winds up getting pushed 2 days. Well, now they're not stressing because they have movers that are supposed to close that same day and get them out and all that kind of stuff. So it makes closings even smoother, because if it does move a day or two, nobody cares, because they still have their house. And again, we're not talking, where they can wait 2-3 years to sell this, but it's a limited amount of time. The funny part is actually the guidelines state that there is no maximum, but it's one of those situations where obviously things are going to change the longer it goes. So you have to remember that. And then also it's also based on Cardinal keeping the loan. If Cardinal doesn't keep the loan, which we are keeping a lot, I mean, I don't know what the numbers are, but they've got to be over 80% right now because I don't see it very often where they get sold. So as long as Cardinal has the loan, they're able to do this. It is not eligible though for FHA or VA. So be aware of that. So if it's FHA or VA, you cannot do it. So it's got to be a conventional Freddie or Fannie loan. Okay, or I guess for that matter, it can't be jumbo. So Fannie or Freddie only. If the loan does get sold, um, it's possible to still do it, but it comes into the terms of the new lender if they allow for it. So, which is possible. It's just impossible to say on our end. We don't want to guarantee anything, but that's why I say if it's done, let's say, you close, let's say June 1st, and then you close on the other one, like, June 25th, there's no problem. Okay. Cause we're still going to have the loan at that point. Matter of fact, it's barely even gone through the part where you even get the introduction letter from us. So those are okay. It does cost $300 to do it, which is actually very cheap. When I did it 20 years ago, they charged me $500. So for what that's worth. Just trying to think if there's any. Oh, and there does have to be a minimum of $5,000. So they can't recast this for like $1,000. They got to recast it for at least $5,000. So the other thing to think about, and so this is how you want to sell it to your clients is, so it's not just taking money and putting it down on the new loan, it's restructured to the new loan amount. Okay. So if let's say they were putting 5%, I'll make the numbers pretty simple. So let's say it's a $200,000 purchase. They got 10%, 5%. So they were able to come up with $10,000 for the down payment. But when they sold their home, now they're going to have another $40,000 to put down. Okay. So right now the loan amount is $190. It's based on a 5% down program. They put another $40,000 down. So now it's based on $50,000 down on a $200,000 place, which now makes the loan to value 75%. So first off, there will be no PMI anymore. And the loan is now based on $150,000 for the payment, not the $190. So most places will let you put more money towards the principal, but that payment is going to stay based on $190. And if they do, and when you put the money down, they'll get rid of the PMI, but the payment will still be based on $190. So they understand, okay, you paid it down below the 78 or 80%, but the original loan was at $190, so that's what the payments for the principal and interest are going to be. Okay. So that's where it's different than everybody else out there. I don't know anybody that's doing this right now. I'm sure there are somewhere, but I have not heard anybody talk about this, which is why it's kind of funny, Michelle, you were saying like what is this? That's the reason, because nobody's talking about this. And it's actually kind of funny because it's like it's come up many times because people, they can't, they want a house so bad, but they can't sell their house fast enough to be able to get into the new place. And this is an option. So even if you think you're going to be able to go, I actually had one with Angels Group where they were going to buy and sell same day. And then there was some delays on their sale. And we went ahead and kept it as that they were doing it this way, and then they actually literally just made the payment or whatever to recast the loan to the new loan amount now. So there's no PMI, lower payments, all the things that they wanted whenever they started. Only difference is they wound up selling their house. I think it was like 2 weeks later. So does that kind of make sense? Any questions? And feel free to unmute yourself. I don't know if I don't think I muted everybody on purpose, so I think you have the ability to unmute if you have questions. No?
I have a question, as always.
Yep.
This is just for purchasing, correct? No refis? You can't like...
Yeah, this is for purchase, correct.
Because you obviously know my situation already, but I would like to roll the condo and the home all into one and try to do it that way, but I guess that's not feasible in this
No,
scenario.
and the other idea is that the person does have to qualify for both mortgages at the same time too. So it's not that they're qualifying for the one and then we're just holding off on the other one. They do have to qualify for both. So we got to get, all the information for the first loan as well as the second one because they have to make enough money to cover both. So if they don't
Gotcha.
if they don't qualify for both, we can't do it. So, because in theory, they're going to have two loans for, whatever it is, 2 days, 2 weeks, 2 months. And so they have to qualify for both. It's not like a bridge loan. Some people have kind of thrown that word out there. It's not anything to keep to bridge the gap. It's it's almost like you're buying a new first home and now the old one is an investment. But nobody's going to live there because you're going to sell it immediately and then take that money to put down on the new home.
So that's a good question. What if somebody does have an investment property they're technically leaving because they just put renters in?
Say that
I guess
one more time.
Never mind. That wouldn't qualify because you can't use the rental income for a year. Never mind.
Okay, and again, once we're done, you guys, if you have other questions, specific scenarios, don't hesitate to call me. We can go through all of them, individually. Big thing is I just want you guys to get a hint of what this is, and then go from there. So the other part that we were going to talk about is the escrow holdback. I'm going to have Rich take over. Rich, I think most of you know Rich. Rich has been, I think we've been together now 15 years, 16 years, something like that. Yeah, I mean, he's my boss, but more a friend than my boss. But he is got amazing abilities to see things when it comes to like the conditions of properties. He has a background in construction, and which is why we've done those type of loans over the years. And so it made a whole lot of sense for Rich to talk about this because of his background.
All righty. Well, thanks everyone. I'm glad to be here. And before we move on to the next topic, just a couple things on that recast deal. Steve does have the ability to do a co-marketing flyer with you. So if you're part of his Total Expert CRM, he can make a co-marketing flyer. And don't underestimate the real sales power of this. It is completely unique to be able to close on a loan and then within a couple of months drop $50, $60, $80,000 to the principal and have the lender, and we're using this fun term recast, the loan so that the new payment is based off of the lower loan amount and also to get rid of PMI. I think I can see many situations where you can use that on a listing appointment or even a buyer's appointment where you can say that your team has this availability so that the end goal is to make your offer stronger, because that's our goal. And so like both of the things that we're talking about today, the end goal is to make it so that your buyers are stronger looking to the sellers, right? So being able to use the recast is a way for you to not have a pre-sale or home to close contingency. And that's pretty strong. The second thing that we're going to talk about is escrow holdbacks. And there's different variations with different lenders. We would not be telling the truth if we were to say we are the only ones that do this, but we have some nuances. So I'm going to go over what an escrow holdback is, how it's used, and then I'm going to explain some of the nuances that we do at Cardinal that make it a little bit more exciting or even make it worth us spending a few minutes talking about it. So think of an escrow holdback as, and let's just say it's October, it's getting cold out. The appraisal comes back and it lists a bunch of conditions, okay? Outside painting that needs to be done, or maybe the roof needs to be repaired, or some fascia is rotted out or something, and it's called out on the appraisal, okay? We've all faced those situations. And let me first say, that most of what I'm talking about is going to be for conventional FHA, VA, and USDA. So it's going to cover the spectrum of properties, 99% of the business that you guys are going to be related to. And so the idea is you get the appraisal back and it says, hey, there's these issues that need to be fixed before we can close. And so oftentimes you normally have to go back, work out a deal with the seller, get these things fixed, somehow get them related. Sometimes you're having your buyer go paint the garage before closing, and it's just kind of a mess. What the escrow holdback that we do does is it allows us to put money aside so that this work can be done after closing. Okay. So the roof repair or the painting or the fascia and those types of things can be done after closing. Okay. The process is fairly simple. With most of the items, we would get 2 quotes from a licensed contractor. Now, if it's just minimal work, like you're just painting the outside garage, we only need 1 quote. Okay. We also allow the borrower to do the work if he's qualified, which is unique to most of the ways that lenders run escrow holdback programs. We get 2 quotes. Sometimes it's 1 if the work is minimal, and then we do allow the borrower to do the work. We'll hold 150% of the dollar amount of the quote in escrow. Borrower will do the work, or the contractor will do the work after closing, and then we pay it out. So before I open it up to, or before I talk about some of Cardinal's nuances, let me just ask if, hopefully I was clear, but I'm sure there's some gaps, and I'm sure that you guys might have some questions. So do you guys have any questions on what I just talked about in terms of an escrow holdback?
So Rich, go ahead.
Go ahead.
I think we unmuted each other at the same time. I just had a question about, is that escrow holdback money part of the loan, or is it something that people have to come out with out of pocket?
It's money they come up with out of pocket.
Okay.
And oftentimes it's the money that the seller is putting up to.
Oh, so it can be a combination of seller funds or buyer funds in escrow. Yeah. Okay.
Yeah, you're still going to be held to seller concession limits on different size transactions. But if you're doing 10% down on a conventional, I think it's 5%. So 6% on FHA and so on and so forth. But for most part, yeah, I mean, some seller money, but buyer money, and it's not part of what we would consider the down payment. So it would have to come, the borrower or someone would have to come up with that money.
Oh.
Good question. Angel, did you have one, or was that the same one?
No, it was the same one.
Awesome.
Yeah.
That's great. So you probably caught on that we were talking about weather related items, right? Things that need to be done because things that you can't do now because of weather, and so can't close a deal. The nuance that Cardinal does is we will allow some non-weather related items. Okay, let me give you an example. Somebody ripped out the carpet of a house, and it now no longer conforms to a conventional mortgage product, right? And so you run into hurdles with that. Cardinal, on a case-by-case basis, will allow us to do an escrow holdback on the carpet or some interior painting. We don't have a specific list because it's done on a case-by-case basis. If we have a 620 credit score borrower with no reserves, we're going to look at doing an escrow holdback differently than we're looking at somebody who's putting 20% down and has some reserves, if that makes sense. So the escrow holdback that most lenders will do is the weather-related items. We take it to a new level by doing it on all mortgage products, conventional, FHA, VA, and USDA. And then we take it to even a new spot in that we will allow some non-weather related items to get done. So how does that help you? Well, it helps you where if you know you're going into a house that has some things that are going to be flagged on the appraisal, that's an opportunity to get us involved and for you to be able to tell the seller, yep, my lender can still handle these without requiring the seller to fix them. And we'll look at each one on a case-by-case basis to ensure that we can get that done. Any questions on that? And does anybody see how that might be helpful? Suzanne's nodding her head. I like that. Thank you for that affirmation and smile.
How long does that review process take?
It's quick. It's just a couple of days.
So you would take the stuff from the appraisal, go back, look at what needs to be done, and then decide, yes, this is something we can do or something we can't.
Yes. So when an appraiser goes out to a property, and first of all, we all know that the appraiser or appraisals are kind of a hit and miss, right? Sometimes they'll catch the peeling paint on an FHA transaction. Sometimes they won't. Sometimes they'll catch things that are broken and take pictures of it and make it look like it's the biggest wart you've ever seen. And at other times they will completely ignore it. So I do like to put that out there because of every appraiser and every appraisal that we get back is sort of unique. That said, when an appraiser notes something that is on an appraisal that needs to be done, and first let's talk about a couple of things. Like we've seen where there's a hole in a roof in a bedroom because of water damage. However, the roof was fixed. Okay. And so like we get this question from you all frequently, which is a great question. Can we close this on a conventional loan without the seller having to fix it? It's going to depend upon how the appraiser looks at it. So the appraiser will take a picture of that big hole in the bedroom and put it on the appraisal, and he will mark the report as required to be fixed, or he'll mark the report as is. Okay. So if he marks the report as is, then generally speaking, we can close that loan without that work being done. Okay. Now, an underwriter can always change their mind and say, you know what, hey, we want that fixed, or we need to look into that, or we want a roofer cert or something like that. But as a general rule, and one of the reasons why Steve and I enjoy working at Cardinal as we have is because our overlays just simply don't exist. We have almost no overlays. In fact, when we were on a conference call with the president of Cardinal, I remember him saying, if our underwriters ever put something on that's not on the Fannie or Freddie feedback, that's when we retrain our underwriters. And we've built our origination system, the software, so that it's very hard for an underwriter to ask for something that's not required by Fannie or Freddie. So that's one of the things. Like, I mean, the things that we're able to do that make life easier for the buyers is in my opinion is the best that I've ever seen. And this is my 30th year in the business. But going back to your question, so once the appraisal comes in and says that repair is required, obviously a conversation will happen. And so if Steve is your loan originator, Steve would be talking with the borrower about those repairs, and we'd get a quote for that repair. And then whether it's one or two quotes, and then we'd submit it to credit committee. Credit committee meets every day at 4 p.m. So I've never seen anything take longer than 48 hours as a turnaround. Most things are done in 24 hours, meaning if we get it in today, it'll be looked at by the 4 p.m. tomorrow. And the credit committee will make a decision on whether to do that. And let me give you a look at the crystal ball that the credit committee looks into. So from my experience, the credit committee wants to close every loan they can, but they have some things that they care about, just as we have things we care about. One of the things is they want to make sure that there's health and safety issues are not an issue, right? If we have something that is going to be detrimental to that homeowner living in that property after closing, they're most likely going to deny that request. And that's reasonable. That's why we have rehab loans, so that they can go that route, right? We're talking about those things that stop a loan that you and I would look at and go, that's really not that big of a deal. I'd live in that house. I don't think it should be stopped. Those are the things that we are able to continue to move forward on. So they're looking at health and safety of the house. And then they're also looking at, is there any potential at all for the lender to get sued? And is there any potential at all for the borrower to get in trouble? In other words, not be able to move in and not be able to make their payment, right? Their goals are reasonable in terms of approving these various types of things. But for me, being able to say, well, that doesn't kill the deal. Let us take it to the next level and go before credit committee. Let's get some quotes and take it before the credit committee is a real strong point, at least for us when talking to realtors, and for realtors when you talk to your listing agents that you're trying to put an offer in on, and you see something that could be a potential issue. Does that make sense? Questions, follow-up? Angel, you look like you're talking, but you're muted.
God, I clicked it there. Now am I talking? Okay.
You sure are.
One of the reasons I started talking to Steve about this is because the market turned to as is.
Mm-hmm.
I feel like in 2 months, all of a sudden every offer is as is.
Right.
Like, okay. And so then you have FHA clients, you can't do as is. So we were talking, him and I, and he talked about this escrow holdback as a possible option for that.
Mm-hmm.
But from what you're saying and from my conversations with Steve, you'd have to walk into a house that really needed nothing but maybe some paint on the outside, right? For an as is with an FHA, if you're going to try to do this escrow holdback.
Well, it just depends. I would look at, is there any health and safety issues? And so I use the example of carpet. We've all been in houses where the carpet's torn up or missing corners and you just see plywood, right? That's probably the most common example that I've seen that holds up, that we get into outside of peeling paint with FHA. And then I guess sometimes you see the broken windows, right? Very rarely do we run across electrical panels that are less than 100 amp anymore and that don't qualify. We used to 20 years ago, but now just about everything has 100 amp panel or higher. And FHA's rules really for that type of thing are minor. And then, it's probably been 5 years now that FHA changed their inspection requirements for appraisals to where it really is only health and safety issues that they're looking at. And I think most realtors aren't aware, excuse me, that FHA did change their policy to just health and safety issues. Angel, did I answer that question for you, or?
You did. I think that it's just going to take some, when you walk through with the client, really asking yourself, if they have FHA, can we do this as is?
Yeah.
And your information is very helpful because they are losing out on lots of bids and VA too, which I think is super unfortunate. Mm-hmm. And I just don't know how to make them more competitive. And again, that's why I was talking to Steve, like what tools are in the toolbox to help these buyers be competitive. And that's why I said escrow holdback was a possibility. But I don't know what else is out there that can help them to be more competitive. But yeah, this is an option for sure.
It is. And then, there's the renovation route as well. both the streamline and the full renovation option. We're limited. Thanks, Suzanne. It was nice to see you today. Good luck on what you're doing, okay? You bet. So those are both options. I tend to think that as we come into the fall, that we're going to see renovation being the next big thing that we're going to have to be working through. You know, the inventory as it is small, but when the CARES, I think it's the CARES Act, right, Steve? When that goes away and lenders are given more flexibility to foreclose on properties, we're going to see a lot more properties that are going to hit the market that are going to need work. And we'll have that ability to do renovation loans. But for now, your point, which is a very valid one, is how do you get an FHA borrower to be able to look strong on an offer? One of the things that I've tried to do personally is to see if they can qualify for conventional, even if it's worse terms than FHA, so that they can go conventional. And then we actually originate it. It's a little sneaky, but it's, you know, we originate it as an FHA, and if we get a clear appraisal, then it's just getting the borrower to sign the form and moving forward. You know, so, you know, you get a borrower with a 650 credit score and they can do conventional, but it's a higher rate and the MI is higher and everything else. So it's better for them to go FHA. We can look at how the appraisal comes back, and if it comes back clean, then changing it to FHA midstream. That's one option, but that does not happen frequently, because oftentimes you either have a borrower that can go conventional, and if not, then we go FHA. You don't there, but there is that kind of small narrow hallway where they could get a conventional loan. It would just be more expensive.
So I have a question about that. Let's just say, for instance, the credit score of a buyer is good, but they don't have that 5% down payment and they really want to do only a 3.5% down payment.
Mhm.
Is that kind of what you're talking about? So qualify them as a conventional, but
Actually,
then switch them to FHA for the 3.5 down instead of 5?
yeah, we actually at Cardinal, we have a 3% down conventional loan.
Oh, you do?
We
How do
should-
Steve, how do I not know about this?
Yeah, I
That's
close,
helpful.
I probably close one of those a month, 3% down, you know, borrow buying a $300,000 house and he's only got 3%. We get a seller credit for the closing costs, and by the time you get the tax credits in, the borrower's really only coming up with about 1.5%. But there, we do have, for somebody that's got a, and let me preface this, Michelle, you did say with a good credit score, right? So
Well, like a 680 or something.
and 680 and above is where I would target. Yeah.
Okay.
Now the rate is going to be higher at that 680, right?
Right.
But then we will look at doing Fannie Mae's Home Ready or Freddie Mac's Home Possible program that allows for the lower credit score, and that gives the borrower the ability to get a better rate. But there's income limitations and area limitations to that. So, you know, generally you have to be in the medium income level. And so I just looked up one in, I think it was Lake County, and the median income was 70,100. So they'd have to be, and Angel, there's the income level changes just depending upon where the property is. And so Steve would have a lookup tool to be able to say whether or not that qualifies. And then we do a little nuance at Cardinal as well, is we only, on one of the programs, we just use base income. So if somebody can qualify for the loan on their base income, even though they're getting a bonus or overtime, and the bonus or overtime puts them over the threshold, we can use the base income for them to qualify for the program and just not count their overtime or bonus. So we do have that 3% down for borrowers with good credit. And I know you said 680. The lower you get below 700, the harder it is for us to get an approval. And the lower the down payment and the ratios, we had one where a buyer, it was a 25/26 ratio, and they had a 679 credit score, and we could not get that approved with 5% down. They had to go to 10. And then when we moved them, Steve actually did some rapid rescoring and some change to get their credit score improved to a 683. And we were able to get that back to an approval with 5%. So, I would look at a higher credit score for that type of buyer. And there is and there is home ownership counseling that goes along with that. So they have to take an online class. And did I get Steve in trouble now, Michelle?
Always.
No, I just have a buyer. Well, Steve was supposed to work with this buyer anyway, and they've shopped around for no reason, and found a different lender. And it's still not working out because it's FHA, and they can't get a house at FHA right now. It's not possible. So I'm sure they qualify for a conventional 3% for sure. So I'm going to have to reroute them back to Steve yet again for probably the third time in a row.
And no, Michelle, we appreciate that very much. We do. Any other questions on that or anything in general?
No, I think that's the big thing. Like Michelle said, these FHA buyers, they're just not getting homes. It's just, and I don't know I just keep hoping I'm going to be seeing more homes come on the market. They just aren't. And it feels like an episode of that shark show on Channel 11, whatever it was they're called, the sharks. You're just out there eating each other alive, trying to get a home for somebody. It's just
Shark Week or something.
Yeah, Shark Week. It's Shark Week every week in the real estate world.
It really is.
And the stuff that keeps, like I said, moving to as is, I was like, wow, okay, now we're in a super bad. I had been saying before that they're going to start asking for their firstborn, and I think that's the next thing.
I mean, they almost are. We're seeing these contracts with the addendums that say if the house appraises below what the contract is, you have to make up the difference.
Yeah, we've seen that too.
And so it is a very strange market, and yet you could find some homes that have just been sitting on the market forever. But
they usually have a lot of work that needs them, which FHA, those buyers won't qualify for those.
Right.
They don't sit unless there's a problem, right, Michelle? If they're out there 10, 15 days, you're like, okay, because it doesn't even matter if it's in a busy intersection. People are snatching those up like crazy too. So if they're going, there's something else big wrong with them.
With all these people leaving Illinois, supposedly, you'd think there'd be more houses on the market, right?
Yeah. That may just be a little overblown, but maybe it's more south. I don't know.
I mean, I know, like, I'm not sure if either of you work in the Bloomingdale area, but some of my realtors are down in that area, and their contracts are coming in 30, 40,000 over list. And I think the thing that surprises me the most is we are having less appraisal problems than I would imagine.
It's scary at the same time because it is sort of reminiscent of 2007 and 2008, but I feel like the buyers are more qualified than they were back then. At least it seems that way. Banks and mortgage companies are being more careful, but I don't know how you get a home on the market at 300 and you end up at 330 and it appraises at 330. What was it priced at 300 for in the first place?
I've asked that question, and that's really something that you guys would know better than us,
Because it's everything around there is at 300.
Yeah. And you are right, Angel, the products are different. So what got us in trouble in 2006, and I always like to point out that Chase created that product. Chase was the one who created the hybrid product. And And you guys are supposed to laugh at that point right there, right?
Why?
Getting chased. But what got that market into trouble was that there were ticking time bombs in that in 3, 5, or 7 years, the rate would adjust. And the rate adjustment wasn't just 1% or 2%. I mean, it could go 5% higher. And so when you have a borrower whose principal and interest payment goes up by 60 to 100%, you're in trouble. You know, to me, that was such common sense. Steve and I can proudly say that we stayed away from that market in 2000 to 2006. It was not a market we went after. We had those BC lenders coming into our office all the time, and we just said, no, thank you. That's not to say we didn't do any of them. I think we might have done a total. Well, I know I did a total of 7 of them. And,
I did 3.
You did 3.
Yeah.
But it was, I mean, we didn't, after communicating with the borrowers what was going to happen, a lot of them chose to just not buy, rightfully so. You know, I mean, we like to do what we do for a living. Both lenders and realtors, we can make a good living doing what we do, but we do have a responsibility to do it ethically and not hurt our clients. And so we made a conscious effort to not go after that business and to not do that business.
Yeah. All right. Well, thank you very much. Appreciate all the information.
Yeah. Yeah.
Thanks for being here, ladies.
Absolutely. It was good to know.
Yeah, good info for sure.
All right.
Good. Well, obviously, if you guys need anything, just give me a ring.
All right. Thanks.
Take care, all.
I'm texting Steve. I'm texting Carrie right now, Carrie Rivera, who you've talked to in the past.
Oh, yeah. Gotcha.
So I'm texting him right now saying, hey, call Steve again, Steve. Thanks. He's got a 3% conventional that you can probably qualify for. So if you want to kick FHA to the curb, you know, make a call.
Sounds great.
All right.
All righty. Take care, everybody.
Okay.
I got
Email.